Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of corporate finance by diving deep into their SEC filings. Get ready because Janel Corporation just dropped their latest quarterly report and it is a doozy. We're talking about a company that has been busy with acquisitions and navigating some interesting financial waters. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. And we also have a Discord community linked in the description below where we break down these reports even further. So, what is the big picture for Janel Corporation as of the 31st of December 2025? Well, they're showing us their financial health, and it is a mixed bag of growth and some areas that need attention. Let's jump right into the numbers. First up, look at their assets. Current assets, which are things they can quickly turn into cash, like cash itself and money owed to them, went up. Their cash and cash equivalents took a bit of a hit, going from about $11 million down to around $6.7 million. That is a significant drop, however. Their accounts receivable, which is money customers owe them, saw a big jump from about $66 million to nearly $77 million. This could mean they're selling more or just taking longer to collect from customers. Now, let's look at their liabilities, the money they owe to others, their current liabilities, the short-term stuff they have to pay soon, also went up quite a bit, reaching over $127 million. A big part of this increase comes from lines of credit. They borrowed over $18 million compared to just a little over $3.8 million before. This suggests they are using more borrowed money to keep things running or to fund their operations and expenses. Across the board, total liabilities are now sitting at over $147 million. That is a lot of debt. But then you look at their stockholders' equity, which represents the owner's stake in the company. This number also saw an increase, climbing to over $28 million. So even though they owe more, the value belonging to the shareholders has also grown. Most of this growth in equity came from non-controlling interests, which basically means other people have a stake in some of their subsidiaries. They've essentially brought more of those businesses fully into the fold by acquiring more stakes. Now, let's look at how much money they're actually bringing in. For the 3 months ending the 31st of December 2025, Janel Corporation reported total revenues of about $56 million. That is a healthy increase of 9.1% compared to the same period last year when they brought in just over $51 million. This growth is good news, and it looks like their acquisitions are contributing to this top line increase. Their gross profit, which is what is left after paying for the direct costs of making their products or providing their services, also went up nicely. It rose by over $3 million to about $18.1 million from $15.1 million. This is a solid increase, showing they are not only selling more but also managing their direct costs effectively, at least on this front. However, when you look at their operating expenses, particularly selling, general and administrative costs, things get a bit more concerning. These expenses jumped significantly from about $13.3 million to over $16.3 million. That is a jump of over $3 million or about 22.6%, while some of this increase is due to acquisitions. It is a substantial rise that eats into their profits. This increase in operating expenses led to a decrease in their income from operations. It dropped from about $1.2 million in the prior year to just under $1 million in this period. So, while sales are up, their ability to turn that into operating profit has weakened. Looking down to the bottom line, their consolidated net income, the actual profit they made, was about $700,000. This is a slight increase from the $659,000 in the prior year, and for Janel Corporation specifically, the net income attributable to them was around $419,000. This translates to earnings per common share. For the period, basic earnings per S-share attributable to common stockholders was $0.27. Diluted earnings per S-share was also $0.27. This shows a slight decrease from the previous year's $0.29 basic and $0.28 diluted. While the overall net income is up a bit, the earnings per S-share are down. This often happens when a company issues more shares, which dilutes the ownership stake of existing shareholders. Let's break this down by their business segments. The logistics segment continues to be their star player. Revenues here surged by 10.3% to over $50.8 million. Their gross profit also saw a fantastic increase of over $3 million, reaching $14.4 million. This segment is clearly benefiting from their acquisitions and is showing strong growth and a healthier profit margin. The life sciences segment is also showing some positive movement. Revenues grew by 14.1% to over $3.4 million, a good portion of which came from the Biocensus acquisition they completed. However, their gross profit margin here dipped slightly, and their selling, general and administrative expenses increased quite a bit. which led to a decrease in income from operations for this segment. The manufacturing segment, which now includes Rubicon, saw its revenues decrease by 21% to about $1.8 million. This segment struggled with lower sales volumes and an unfavorable product mix, resulting in a loss from operations of about $39,000. It is clear this segment is facing headwinds. Now, let's talk about the corporate expenses. These are the costs associated with running the parent company, not tied to a specific segment. And wow, these expenses more than doubled, increasing by nearly 70% to over $2.7 million. A big chunk of this jump is due to merger and acquisition related costs, and also amortization expenses. This means while the individual businesses might be performing okay, the overhead at the corporate level is really climbing. And speaking of costs, their interest expense also saw a significant drop, decreasing by over 50% to about $305,000. This is good news and likely a result of paying down some debt or securing better interest rates. Interestingly, they recorded a gain on consolidation of acquisition of nearly $850,000. This usually happens when a company acquires another business and the value of the net assets acquired exceeds the purchase price. It is a one-time boost to their income. Their other expense net category shows a negative swing. It went from a positive income of over $300,000 to an expense of over $370,000. This is largely due to the write-off of unamortized loan fees related to their new credit facility. Now, a crucial part of any company's health is its cash flow. For the 3-month ended the 31st of December 2025, Janel Corporation used over $14.5 million in cash from operating activities. This is a massive decrease compared to the over $1.7 million they generated in the same period last year. This big shift is primarily attributed to an increase in accounts receivable and a decrease in accounts payable, meaning they are either paying their suppliers faster or taking longer to collect from customers, and it is impacting their cash reserves negatively. In terms of investing activities, they used about $120,000, which is less than the $324,000 they used last year. This reduction is mainly because they spent less on acquisitions, which makes sense given the cash flow situation. On the financing side, they generated over $10.4 million. This is a huge turnaround from using $252,000 last year. This influx of cash seems to be from drawing on their credit lines, but they also spent over $2 million to buy more shares of Rubicon and made a significant payment for an earnout, which are both substantial outflows. Looking at their liquidity and capital resources, they acknowledge their reliance on commercial credit facilities. As a customs broker, their logistics arm frequently makes cash advances for duties and taxes on behalf of customers, which can affect their collection metrics. They also mention that they generally do not make significant capital expenditures, which is typical for a service-based business. In their own words, Janel Corporation is focused on growing through acquisitions and organic growth within their 3 business segments: logistics, life sciences, and manufacturing. Their strategy is to find reasonably priced companies with strong management and predictable earnings. They've certainly been executing on the acquisition part, but the operational results show a mixed picture. Consolidated revenue for the 3 months ended the 31st of December 2025 was $56,039, which was $4,685, or 9.1% higher than the prior year period. This increase in revenue is consistent with what we saw earlier, showing that acquisitions are indeed driving top-line growth. However, income from operations for the 3 months ended the 31st of December 2025 was $978 compared to $1,209 in the prior year period. This decrease is a key point. They explain that it is due to less income from operations in their life sciences and manufacturing segments and higher professional service expenses in the corporate segment, partially offset by higher income from operations in their logistics segment. This tells us that while logistics is strong, the other segments and the corporate overhead are weighing them down. They also talk about adjusted operating income, a non-GAAP measure. For the 3 months ended the 31st of December 2025, it was $2,028, a slight decrease from $2,041 in the prior year. This adjusted figure still shows a slight decline, reinforcing the idea that even when you smooth out some specific costs, the underlying operational profitability has not improved and has slightly worsened. Let's dive a bit deeper into logistics. Their revenue for this segment was $50,829, a significant increase from $46,086 in the prior year. Their gross profit margin improved to 28.2% from 24.7%. They attribute this to overall freight rates declining, making their services more competitive and profitable. This segment is definitely their engine right now. In life sciences, revenue increased to 3,404, but the gross profit margin slipped to 82.9% from 84.9%. They mention higher costs from selling acquired inventory and increased selling general and administrative expenses due to the biosensors acquisition. This led to a drop in income from operations for this segment. The manufacturing segment, which includes Rubicon only from mid-October, saw revenues fall to 1,806 from 2,285. They attribute this to a decline in sales volumes due to general economic conditions. The gross profit margin also decreased, and they reported a loss from operations of 39,000. This segment is definitely struggling. On a more positive operational note, management has evaluated their disclosure controls and procedures and concluded that they are effective. This means they have reasonable assurance that the information they report is accurate and timely. This is a fundamental requirement for public companies and good to see. Regarding legal matters, they state they are subject to claims and lawsuits in the normal course of business, but management does not believe that the outcome of any of these will have a material adverse effect on the company. It sounds like they are managing these risks. They also refer back to their annual report for risk factors, indicating no material changes to those risks. This implies that the existing risks such as acquisition integration issues, competition, economic downturns, and regulatory changes are still very much in play. Now, let's put on our investor hat and look at the bigger picture for Janel Corporation. On the surface, Janel is growing. Their total revenue is up significantly, driven by their aggressive acquisition strategy, particularly in the logistics sector. That segment's improved margins are a really positive sign, showing they can leverage their acquisitions for better profitability. The corporate overhead is a concern, as are the operational struggles in the manufacturing segment. The most eye-catching point is the cash flow. A company that suddenly uses over $14 million in operating cash when it was generating cash just a year ago is a red flag. This drastic shift, coupled with a significant increase in lines of credit, suggests they are under pressure to fund their operations and might be starting to lean more heavily on borrowed money, while they have managed to increase their equity. The massive jump in liabilities, especially short-term ones due to drawing on credit lines, needs close watching. Their strategy of growth through acquisition is clear, but the execution seems to be a bit uneven. Logistics is firing on all cylinders, but manufacturing is dragging, and life sciences is showing some strain from integration costs. The increase in corporate expenses is also something to keep an eye on. From a Warren Buffett style perspective, we look for companies with strong competitive advantages, predictable earnings, and competent management. Janel clearly has a growth strategy and seems to be executing on acquisitions. However, the declining operating income despite revenue growth and the negative operating cash flow are concerns. The increased debt load and the dilution effect on earnings, per S-Hair, are also points to consider. The company's direction appears to be towards consolidation and expansion, but the immediate challenge seems to be managing the increased costs and integrating new businesses effectively so that they contribute positively to the bottom line and cash flow, not just the top line. The risk factors mention potential for impairment of acquired assets and failure to realize expected benefits, which is very relevant given the current performance of some segments. Overall, Janel Corporation is in a period of significant transition and growth. The logistics segment is a strong asset, but the company needs to carefully manage its debt, control corporate expenses, and ensure its acquired businesses deliver on profitability and cash flow generation. The next few quarters will be critical in determining if their acquisition-driven growth is truly sustainable and profitable. Alright, that is our breakdown of Janel Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord community in the description for more discussions like this. Thanks for watching, see you next time.